Hello everybody, welcome to another update on the stock screener. Today we are going to talk about Frontera Energy, which is a new gem that I discovered. I'm probably going to buy some on Monday because the fundamentals are very sound. So let's talk about the fundamentals. It has a market cap of 1 billion. Price to book very cheap. It's trading at below 70% of book value. And you can see that here, equity is 1.5 billion. Okay, very cheap. Earnings, they had earnings about 450 million per year. You can look at the revenue here. So net income was around 100 million times 4 is 400 million. At $90, today we are at 111 oil price. So that's a PE of 2. Very cheap. Debt is at 1 billion. So they have quite a lot of debt, but with 400 million earnings per year, they can easily pay it off. When you look at the balance sheet, they have quite a lot of debt, 500 million long-term debt and current portion 100. So you can easily pay it off in 1 year. So that's no problem. They are also doing buybacks right now. So that's because they are so cheap. EBITDA is the production times oil price minus costs, and that's about 1 billion EBITDA. Okay, 1 billion EBITDA, and it's also verified in my sensitivity analysis. So they have EBITDA like this, and we made a linear chart on that. So we have 111 oil, so EBITDA is around 900, and that's exactly the same here. AISC is around 45 per barrel, and I have verified that in the first quarter results. When you look at the costs, you see here they sold at $90. I used the $90 as well in my earnings here, $90. And they have costs on put options. So these are risk management contract put options. They hedge some of their oil. They have royalties to pay, dilution costs, production costs, transportation costs, and this is the operating netback, which is the EBITDA that they get after all the costs. So if you do 90 minus 50, then you get around 40 AISC. So I have taken 45 just to be conservative. The mine life can be found here in their reserves release for 2021. They have about $167 million of, 167 barrels of oil equivalent. So that's what I put here, 167 million of oil in the ground. So the mine life is this divided by the production, and the production, by the way, is 41,000 barrels of oil equivalent per day times 365 is for 1 year. So you get a mine life of around 11. And that's exactly what they say here, mine life of 13. So we have an NPV that's also set here, NPV of 2.5. That's between these two numbers, 2.5 for $70. So the NPV is probably now around 5 billion because the oil price is much higher. And this is for 10% interest. So I also did my calculation on EBITDA valuation, and that's the production times oil price minus cost times 5 multiple. And you can see that We have a valuation of 5 billion. Currently, the market cap is 1 billion. So there's plenty of upside, probably a double from here. They have natural gas and heavy oil, 1/2. I like this natural gas portion because it will rise in the future. Let's see here, we have the financials. So equity is rising and net earnings are positive, around 30% net earnings margin between revenue and net income. So it's a very profitable business as oil prices stay at 111. So we need to keep an eye on this. But I think oil will be pretty elevated for some time. So even if oil goes to 70, it's still undervalued. Then it would only be a double in 5 years, like right? So there's plenty of upside in this company. And if you believe in oil, this company is going to be a cash cow. So that's about it that I can say about this company. They have some cash, and I think this is a great buying opportunity. They have some put options here at $70 oil. Yeah, these are the reserves. We'll give 5 billion NPV in 10 years. So I think this is an easy double. And people don't know it yet, but only risk is that they are in Colombia, Ecuador, Guyana. That's the only risk that I see. But other than that, this is a profitable company with plenty of mine life left. And they are probably going to explore for more. So I'm buyer at this level. And I'll see you in the next video. Bye.